Hello and welcome to Domicile Corporate Services podcast series Advancing Vietnam with me, Vlad Savin and Matthew Lowry. Throughout the following episodes, we'll look into answering relevant questions about doing business in Vietnam. What are the opportunities and challenges faced by investors entering the market or existing players in major industries? We will seek to understand the business environment from a cultural and local mindset and how to deal with compliance from an international perspective. What are the major risks faced by businesses active in the region and how to overcome them? And last but not least, we will dive deep into the compliance environment in Vietnam, discussing processes and procedures, changes in laws, latest official updates from the authorities, and financial governance planning for businesses active in Vietnam. In this episode, I'm discussing with Matthew Lowry, Managing Partner of Domicile Corporate Services, about taxation compliance in Vietnam, looking at effective tax strategies, incentives, double taxation agreement, and understanding how companies manage their tax obligations in a proactive manner. Matthew, welcome to our 9th episode of Advancing Vietnam podcast series. Happy to have you here for another interesting topic.
Thank you, Vlad. I'm looking forward to sharing more about the subject, as taxation is a major corporate governance issue and element for investors to understand and be on top of in Vietnam.
Matthew, from a broad perspective, what are the main tax obligations companies operating in Vietnam need to be aware of and plan accordingly? We're talking here about corporate income tax, VAT, and other common taxes relevant for investors.
So, thanks, Vlad. There's as you mentioned, quite a lot of taxes, and even though there's a lot of taxes, you need to treat each of them separately and understand each of the implications separately. So we've got corporate income tax, which is a tax on the profits of a company. We've got value-added tax, which is a 10%, generally a 10% tax levied on consumption, so borne by the final user but paid all the way through. You've got foreign contractor withholding taxes, which are payments with amounts withheld on payments abroad for services. You've got personal income tax, which is levied on employees out of their earnings. You've got customs duties and import-related taxes. You've also got special sales taxes, which are wholesale sales taxes on particular things such as gambling or on alcohol, cigarettes, etc. You have also transfer pricing issues, you have tax adjustments, and you can have other matters such as capital gains tax or tax on capital transfers. There's some other taxes around, but you've got quite a broad spread there. They're not inconsistent with other countries, but they all act subtly differently in Vietnam than most countries where they would act.
And speaking of corporate income tax, how can businesses determine the application of effective corporate income taxes in Vietnam and their rates, and how they undertake an efficient treasury planning?
So the good thing with that is that Vietnam has a fairly consistent rate for most enterprises. So you get this flat 20% tax on profits, and that is, most enterprises have that. Now we have a special arrangement for 2020 due to COVID, where there is for taxpayers less than 200 million Vietnam dong, or about 8.6 million US dollars in revenue, will have a tax rate reduced by 30%, so effectively 14%, but as a rule, 20%. You can have some tax incentives, you can have some holidays, depending on your sector, etc. And you can pay a high tax if you're in an area such as mining or extractive industries. But the vast majority, it is 20%. And that makes it easier to do your treasury planning because you're not trying to play around with tax efficiencies too much, because you've got a fairly standard. And in the region, it's marginally higher than Singapore or Hong Kong, but it is lower than a lot of Western countries and a lot of developed countries in what taxes they charge. So it puts Vietnam in a good position from a planning point of view. Notwithstanding our currency controls and other matters which feed into Treasury, but the tax element, the corporate income tax element, is a simpler one to deal with and to plan for.
When engaging with our clients, there are sometimes confusions about foreign contractor withholding tax and the way it works. Can you explain more on this matter?
It's probably one of the more confused tax or sort of element, but also probably the most error prone. When we do reviews, we find more errors with trying to comply with that. The concept of foreign contractor withholding tax is that any payment abroad for services consumed in Vietnam needs to have taxes applied. So if payment is coming from Vietnam for a service that's been consumed, there needs to be a tax element. Otherwise, it's cheaper to consume abroad than it is in Vietnam. So if I'm a Vietnamese business and I'm buying a service in Vietnam, taxes are levied. If I'm consuming a service from abroad, the authorities require a tax impost to that to make sure that it's even. When you're importing physical goods, you'll pay duties at the border. But you're importing services, that's where foreign contractor tax comes in. So the withholding occurs. The rates differ depending upon what the services are. The default and the most common rate is 5 plus 5. So a 10% impost on the transaction. 5% is corporate income tax. So effectively assuming there's a profit on that from the provider. And 5% is VAT. The VAT is creditable in the normal value-added tax system. The 10% corporate income tax is theoretically applicable to the foreign party, but withheld in Vietnam, and the foreign party can get a credit for that. So that 10% standard, it could be 15, it could be as low as 6, is something that needs to be understood the nature of the transaction. You need to comply within 10 days of the payment. The bank will actually process, make sure your tax commitments are being made, but you understand what it is and how to calculate it. So that comes back to your contracts need to be very clear and written in light of what the implications are, so that you don't have an impost of withholding tax that you didn't realise when you're negotiating with your foreign parties. So that sounds complicated. Once you understand and have that, it's relatively easy, and the authorities here, it's a process. It's not a challenge to do it. It's just a process that you go through, and it becomes quite easy to do time after time. But it is sort of misunderstood by many, and they ignore it and pay the price later.
And you mentioned just before about incentives. Are there any substantial tax incentives for companies operating in Vietnam, and how can investors take advantage of these?
So you've got a range of incentives, but for most investors, I'll honestly say that they're not the primary incentive for moving to Vietnam. So if you're a large business and you commit a certain significant amount of funds, employment, and deploy within the first few years, you can get exemptions on the national level, and those exemptions can be significant. It can be tax-free periods and then can be tax-reduced periods for 15 years. So they're significant. And historically, there are companies that receive these for long periods or lifetime that have these benefits, even though they weren't project of significance. The laws used to have them for a whole range of incentives. So you've got these large-scale projects. You've got regional, so certain industrial parks in certain regions have incentives. So usually those who are a focus, you might have industrial parks in the centre or disadvantaged regions where the authorities are trying to push, and they will give incentives for setting up operations. Again, you get a tax-free period and then maybe a 50% tax reduction for the next 10 years after that. But that requires you to commit to that location, and your company must be established in that particular location. You can't establish somewhere else and then try to avail yourself to that. You've then got such as high tech, so technology and IT can be subject to it. It's not quite that all IT companies can, but IT companies, there are mechanisms where they can be subject to reduced taxes or tax incentives. You've got those who are doing education may be able to, depending on the nature. Those who are working in rural areas, so if you're in the highlands, etc., you can seek tax incentives. And also the last one of many note is disadvantaged. So if you're dealing with disabled or those sort of things. And so there's a lot of tax incentives, but for the bulk of businesses entering Vietnam, they'll be paying 20%, and the tax incentives usually not available. You've got to seek it out. And as I say, if you need to seek out a tax incentive to make the business model effective in Vietnam, it's probably not the right location to do it. They're a bonus if you're able to get it, to access them.
I see. Transfer pricing is an important part of regional tax planning for international groups operating in country. When should investors look into the TP documentation, and what steps should be taken to assess their status?
Transfer pricing should be done by awareness should be by all companies. So even though the threshold's 50 million Vietnam dong revenue and 50 billion Vietnam dong revenue and 30 billion Vietnam dong in related party transactions, that's the threshold above that to which you need full documentation. Below that, you still must make sure that you're not doing anti-avoidance, but you've got to be ready that if you breach, that you're covered. So I tell everyone that they need to be aware of transfer pricing, they need to be aware of the thresholds, they need to be aware of the process. If you are above those thresholds, you have a choice either to follow some of the benchmarks they give you. So if you're a manufacturer, you might be able to use a 10% benchmark. If you're a distributor, 5%. If you're a, etc., there's a 15%. But for most companies, they won't be able to access those thresholds, those benchmarks, and will need to have documentation to support. The documentation is following the OECD standards, but there are variations. It must be in Vietnamese language. And that is country by country report. You might need a master report, etc. So the documentation process does have requirements, and it is significant. If the authorities choose to inspect, you have 30 days to produce those documents, which generally is not for a study. If you are reliant on a transfer pricing study, which most people are to justify their margins, 30 days would not be generally enough for a study and document preparation and translation. So I always encourage people to be aware of it and prepare in advance, and don't hope that you can get out of it if the authorities wish to investigate. You need to be ready for it at all times.
Can you share a few details about the special sales tax? The rates here differ substantially depending on the products. For example, for automobiles, the rate is between 10% and 150%. How can investors manage these?
So your special sales tax is not uncommon. It's as operates in a number of countries. So you're looking at products the government wants to control, or social ills or control. So your tobacco, your alcohol, your motor vehicles, karaoke, entertainment, there are certain things I want to do. The rates can vary. The rates are all published, so you can actually analyse where you fit into the process. The issue is going to be things like alcohol. If you're a craft brewery making beer, and you start selling your product, unless you're using a wholesaler, because special sales tax is a wholesale sales tax, unless you're using a wholesaler, that tax may be applied at the end consumption, and the rates can be, like a beer is 70%, those rates can be on the final price. Because it's a wholesale sales tax, if there's an independent wholesale element, the tax stops at that wholesale level. So whenever you're part of a product chain that deals with these products that have a special sales tax component, you need to make sure your structuring, your wholesale, your distribution is done in a very tax effective way, that you've done your planning, that you don't end up having what is a wholesale tax being a retail tax. So you want to push it down. Now, karaoke, you can't get around that, of course, because it's paid by the consumption at the end, but they're here as regulated. The trick is not to worry that how are you going to know about it. It's pick your product, apply the rate. The rates are all there, and it's just a matter of getting the structure right to minimise the rates being applied, not which rates really apply, in my opinion.
And going back to tax liability in general, how can companies maximize their company's deductible expenses to efficiently manage their corporate tax liabilities?
So to answer that, you've got to look at documentation firstly in Vietnam. So everything's documentation based. Do you have Vietnamese invoices, or if you've done foreign contractor tax, the tax payments, import documents, you need that supportive documentation. You need to have the contracts behind those invoices. You need to have the delivery notes. You need to have the evidence of transactions. So if you maintain your evidence and if you're documenting it, you're generally okay. If you, for example, are buying products, and I use the example of a pizza restaurant, the law requires you to be able to match them and follow things through. So if you're selling pizzas, how many grams of flour, how many ounces of grams of cheese or pepperoni are going into it? So you need pizza. What's the recipe? So then you can show that you bought 1 sack of flour and this is where it went, and that it all matches. Otherwise, you need to deal with proving that the inputs were used with the outputs. And the difference of Vietnam, it is, in some countries you might have a rule where expenses are deductible where they're incurred in the business. Vietnam is essentially expenses are deductible where they're necessarily incurred. And the authorities need to know they're a necessary part or are directly connected with the revenue. So if you've got ambiguous expenses, you've bought yourself a Ferrari, and where's the connection? You will have issues with deductibility. So that last allocating project costs, tracking those will become an important part to ensure that deductions don't get denied by the authorities as not being necessary for the business.
And what about what about double tax agreements enforceable in Vietnam? And how can investors take advantage of these and plan their group level taxation compliance?
So Vietnam has almost 80 double tax agreements. Vietnam's quite comfortable with doing double tax agreements. So most developed nations, Vietnam have a double tax agreement. They, by default, you must apply them and must seek to apply for most of the things. So they're not automatic, and the authorities will follow the double tax agreements, which can be quite favourable. Vietnam has low withholdings anyway, so sometimes they're not as necessary, but they specify the rules and they go through where there's permanent establishment risk, where if there's personal income tax, who gets the right to tax, etc. But most importantly is the tax relief, so that most double tax agreements have the provision for the avoidance of double tax, in that if it's a taxpayer in one country, that withholding tax, for example, I mentioned earlier, for foreign contractors, part of that may not need to be withheld, the corporate income tax portion, if you can apply and get acceptance to apply the double tax agreement. So those sort of scenarios start becoming quite useful. So if I'm not withholding 5% of a payment, that 5% is going to be significant. I don't have to pay it and claim it back. It becomes a significant cash flow benefit, particularly where there's large payments between Vietnamese and foreign parties. That can start becoming quite useful. The failure people often make with the DTAs is they assume they apply and they can automatically use them. In most cases, you must make application and the authorities accept that you can use them. They are not yours by default.
The Vietnamese government recently released a resolution dated in June 2020, which aims to provide small and medium-sized enterprises with corporate income tax reductions for 2020 as a stimulus measure. Can you share more information on this matter? And are there any tax breaks planned by the authorities this year to support the economy?
I'll answer your second part first. We don't know what else is coming out. The economy is holding up reasonably well. We've got positive growth. It's dropped dramatically with COVID, but at the same time, it is holding up with positive growth relatively well. And the Vietnamese authorities don't have deep coffers to be able to pump a lot of money into the system. What they're doing is using reduced tax collections to try as a stimulus measure, but we're not seeing large payments, a large amount of money pumped in from Treasury. So I think that's the nature of a developing economy that is not, they just don't have the reserves to do that. So tax has been a primary measure of how they're trying to do it. Initially, earlier in the year, they did tax deferrals. They deferred payments by up to 5 months. So a lot of the tax obligations were being pushed out to give people time. And then the June release you refer to is where they've come and gave a reduction of 30% to the standard tax rate for the full year. So instead of having a 20% headline corporate income tax, we now have a 14% headline corporate income tax for taxpayers with revenue of less than 200 billion, so about 8.6 million, 8.5 million US dollars. They will not only pay a 14% tax for the year. This came in during the year. A lot of people have prepaid certain amounts or deferred certain amounts. It's interesting to what extent that'll be useful. And a lot of the taxpayers that need the assistance from the authorities probably aren't making any profit, so their tax rate may be zero for this year. So I'm not sure of how effective the stimulus is, but from a tax planning point of view, a tax reduction is better than no tax reduction. They may continue this next year. They may provide other deferrals. We're yet to see them. But again, as I said before, I don't anticipate there'll be injections of cash into the economy, just because that's not a tool that the Vietnamese authorities probably have access to like some countries do.
And speaking of tax planning, to come back with the last question, when do Vietnamese entities need to finalize their tax declarations, and what are the main steps to complete this process?
Okay, so the standard Vietnamese tax year is 1 January to 31 December. You can do an alternate tax year, which can be end of any of the quarters. So there's 4 potential dates, but the standard is the calendar year. And I would normally encourage those, unless there's a group reason, to keep that, because all the tax incentives, tax rules, everything are built around the standard calendar year. You have a quarterly provisional corporate income tax obligation. So at the end of quarter 1 into March, so in April, you need to pay a provisional tax. By the end of your 4th provisional tax payment, you need to have paid 80% of your full year tax liability. So when you finish your December year, you make your January provisional tax payment. That January payment and all the payments prior must equal 80% of your liability. So even though you have 4 months after year end to finalise your tax and make your final payment, you need to have a very good estimate of your taxation by December into January. Otherwise, you may have penalties for not having paid sufficient provisional tax. Your other deadlines are your VAT is a quarterly or monthly. and your PIT matches the quarterly and monthly. So if you're a small taxpayer, you'll pay your VAT and your PIT at the end of each quarter, the same date as your provisional corporate income tax. If you're large, you'll pay that every month. As you go, you've got to do a monthly contribution. Your foreign contractor withholding taxes paid within 10 days of the event of each foreign payment. And then your other things that you might have, your special sales taxes paid on a monthly basis or a quarterly basis, depending on what it is, and your other taxes are sort of as they arise. So your calendar, you can map out a calendar. On our website, we actually have a calendar we produce which goes through all those key dates to make sure that people understand their filings, responsibilities, and lodge on time. It isn't complicated, but there are quite a lot of dates and things to do, and most of these lodgements are electronically with manual filings to support them.
Matthew, unfortunately our time is up. Thank you for the practical advice on this important topic for investors.
You're welcome, Vlad, and hopefully that wasn't too confusing for everyone or too boring, because tax is not the most exciting subject, but it's necessary for people to understand.
Investors need to pay critical attention to their tax strategy development, making sure their internal corporate policies match the Vietnamese tax compliance requirements. Considering the potential ramifications, companies doing business in Vietnam should always have an effective risk strategy for their taxation compliance. Many thanks to you, our listeners, for tuning in to Advanced in Vietnam podcast series. For more information about this topic, please check out our publications on domicilecs.com. And if you want to reach out to us for any additional details, feel free to contact myself or Matthew on LinkedIn or through the website contact details.